Hi students, so welcome back to today's session on cash flow statement. So we are in financial management portion, and today we are going to discuss about the cash flow statement direct method. What is direct method, what is the format for direct method, and one example for problem for direct method. And very shortly I will release a video for indirect method and example for indirect method. So cash flow statement is a very easy question. One reason why it is an easy question is we can see the verify the answers, and whether it is tallying with the balance sheet. Balance sheet will have previous year balance sheet will be given in the question, and current year balance sheet will also be given in the question. In the balance sheet, cash and cash equivalents will be there in the asset side. If you see the difference between the cash and cash equivalents, opening cash and cash equivalent, and closing cash and cash, whatever is the difference, and that difference will be equal to the cash flow statements result. Okay, so we can easily check the answer whether it is correct or not. That is the only main reason that cash flow statement problems are very easy. It will take a little time for you have any choices which you know very well, you can proceed with that. Okay, but if you want to attend this will take a lot of time. Maybe you have to save more time on the cost and management accounting, so that you will have free time to attend the cash flow statement. Okay, let's move on to today's session. So here we are going to see about the direct method. What is direct method? In the direct method, the cash flow from direct method is determined by changes in cash receipts and payments that are reported in the cash flow from operation section. So cash flow statement will have three sections. The first section is cash flow from operating activity. The second section is cash flow from investing activity, and third section is cash flow from financing activity. So what is operating activity? For example, your company is a chemical manufacturing company. So anything related to manufacturing of chemicals, okay, it may be your sales to customer, it may be some purchases from your suppliers, okay, it may be your inventory stock that you use for consumption for manufacturing of your chemical, okay, and depreciation of your assets used for manufacturing of that chemical. So all these things are part and parcel of your operations. So there will be lot of cash flows that have happened. So expenses is different, cash flow is different. What is difference between expense and cash flow? If there is a expenditure and we are going to pay for it right away, for example, I am buying something for some consumable for my factory, and 10 rupees I am going to immediately pay for that, then it is an expenditure and the cash flow has happened for that expenditure. But now I'm buying the same consumable for 10 rupees and I'm going to pay only 10 days later, then expense has happened, that will be recorded in your creditors in your balance sheet, but cash flow has not yet happened. Okay, so cash flow will happen only after 10 days. At the time only the cash flow will happen. So you will be given the financial statement in your question, the P&L and the balance sheet. So what all the cash flow has happened, what all has not happened, that is what we are going to detect from the cash flow statement. Now let's proceed with this. I think this is what is the operation things will be accounted under the operation activity, and all the investing things will be under the investing activity, and financing things through debentures we will get some cash flow, to issue of equity shares we will get some income, and not income, from inflow of money, capital. Okay, also through a term loan or a bank loan we will get some money from the bank for investing on the business. So all these are financing activity. Then what are investing activity? Investing activities examples are purchase and sale of fixed assets. So fixed assets is an investment, though it is used for your operations, but depreciation of the fixed assets will go for the operation, but investing on the fixed asset will be an investing activity. Purchase and sale of investment, interest received, okay, we are investing in a fixed deposit and interest received, that is an investment. Same way the dividend received, we are investing on the share of a particular company and we are getting back dividends. So dividend is also a investing activity, cash inflow. So these are all investing activity. So why this is called direct method is, Directly we are calculating the cash flow, cash receipts from customers, cash paid to suppliers, employees. This is called cash generated. What if if you have a positive figure after reducing the payment made to the suppliers and the employees, that is cash generated from operations. Adjust for the income taxes paid. Okay, cash flow from before extraordinary item, you can adjust for the extraordinary items, then you can find the cash generated from operating activity. So this operating profit or cash generated before working capital changes. Till this, direct method and indirect method are different. Okay, so direct method will direct cash coming from customer, direct payment to the suppliers and employees. So these are all direct methodology. That's why we are calling it as direct method. In indirect method, it is different. I will release that in the next video. Okay, so for investing activity and financing activity, the approach is very same in the direct method and indirect method, but for cash flow from operating activity, the methodology is little different. Okay, now let's see one example problem of how to do the cash flow statement in direct method. Okay, from the information contained in the income statement, so income statement and balance sheet is given. Okay, so income statement only for current year is given, so I'm putting CY here. CY means current year. If previous year and current year income statement is given, then we have to use indirect method. Now only the current year income statement is given, we have to use direct method only. So the balance sheet and income statement is given, so prepare the cash flow statement. So one detail is given: original cost of equipment sold during the year was 7,20,000. So some equipment has been sold, which is a fixed asset that has been sold, and original cost of it is 7.2 lakhs. Okay, so that detail is given. So what is the thing is, some equipment has been sold, so we have to be careful while doing the investing activity cash flow. That is the crux that is coming in. Okay, so what we are going to find from here? So here we are going to find, the first step is cash flow from operating activity, next will be cash flow from investing activity, and then we will find the cash flow from financing activity, and total all this we will find the total cash and cash equivalents generated during this period, and then we will tally this with opening and closing cash balance given in the balance sheet, and if that tallies, your answer is correct. So let's go to the first step, which is cash flow from operating activity. The first cash flow is cash receipt from customer. How to find the cash receipt from customer? We have the sales. Sales is 2.5 crores. Whether for the sales we have received the cash payment or not, we don't know. So whether cash flow has happened or not, we don't know. But we have balance sheet closing for the last year also, and also for the current year, which means we have the balance sheet for the, I'm saying it as PY, which is previous year, and CY, which is current year. So balance sheet we have for the two periods, P&L we have for one period, that is current year only. Now we have to see any sales, credit sales will be reflected in the debtors. And if you see, debtors opening was 16.8 lakhs, closing is 18.6 lakhs. So what does this show? Your debtors has gone up. So which means your pending payments from customers has gone up. So pending payments has gone up, which means your cash flow has gone down. Okay, so which means 2.5 crores. So 2.5 crores is the sales, and adding the opening debtor and close and reducing the closing debtor, I will give the actual cash flow is only 2.5 crores. So 2.52 crores is the sales, 2.5 crores is the cash received from the customer. Okay, so that is the cash received from the customer that we have put here. The second thing is what we have paid to supplier and employees. Okay, so here this is has to be very careful. So in the P&L you have been given the cost of goods sold. So what is the cost of goods sold? Cost of goods sold will include all the materials and the indirect materials, consumables, everything will be there in the cost of goods sold, 1.98 crores. So that is the 1.98 crores. Now we have to do adjustment with the help of balance sheet figures to find what is the real expenses or real cash that we have paid out. Then only we can incorporate this into cash flow statement. Okay, so now we have the cost of goods sold. Other than that, what is the operating expenses is also a expenditure. So 8 lakhs is operating expenditure, that also we have taken it here, and salaries and wages is also taken out here, because cost of goods sold plus operation expenses plus salaries and wages putting together is the total cash paid for supplier and employees. So I am taking all this 1.98 crore, 8 lakh and 24 lakh put together, 2.3 lakh is the total expenses. So how much we have to do the working capital adjustment to find the actual cash that has gone out. Now we will see what is the creditor. So supplier data we have taken, cost of goods sold will have the material which is bought from the supplier also. So we have to do the adjustment for the creditor. Same way for cash receipt from customer, we did the adjustment for debtors. So same way for COGS, we have to do adjustment for the creditors. So what is the creditor at the beginning? So creditors at the beginning is 24 lakhs. Creditor at the close is 23.4 lakhs. Which means creditors has gone down, which means payment pending, payment which we should make to the supplier. Supplier payments pending has gone down. Supplier payments pending, higher pending is good for the cash flow. Now supplier payments pending has gone, which means we have paid more to the supplier, paid maybe early to the supplier. Okay, so which means our cash flow has gone down. So creditors at the beginning is added and creditors at the end is reduced. So this is the creditor adjustment. So next adjustment for the working capital is the inventory. Inventory means it's stock. Stock is material. So material is also part of cost of goods sold, COGS. That's why we are adjusting for the material also. Here creditor is in the liability side, we adjusted. So stock is in the asset side, so stock at the end. So we added creditor at the beginning, but we should add stock at the end and reduce the stock at the beginning. So this is the stock adjustment we are making. So what is the stock says? So stock says 26.4 lakhs was your closing inventory in the last year, which means opening inventory for the current year. Only 9.6 lakhs is the inventory closing for the current year, which means inventory has gone down significantly, which is good for the company, good for the cash flow. Your cash would be locked in the stock, but now the stock is very less, which means the cash will be liquidated and flown into your banks, cash and cash equivalent, it would have flown into your bank account. So this is good for the company. Next is the advances at the end. Advances is also asset. So similar to stock, we will add the advances at the end 90,000, reduce the advances at the beginning, which is 78,000. So adjustment for the advances is also made. The last one is the outstanding expenses. So outstanding expenses is in the liability side. Treatment is same as the sundry creditors. So outstanding expenses at the beginning will be added, outstanding expenses at the end will be reduced. And if you see here, outstanding expenses at the beginning is 2.4 lakhs and outstanding expenses 4.8 lakhs in the current year, which means it has increased. Outstanding expenses has increased in the balance sheet, which means our yet to be payment our payment pending amount has gone up, which is good for the cash flow. Okay, so that's why you are adding 2.4 lakhs and you are reducing 4.8 lakhs. Okay, and now you are adjusting and you are finding the total cash that is paid out is 2.11 crore. Now we are taking this figure to the cash flow statement. So cash receipt from customer minus cash paid to the supplier and employees, okay, is the cash generated from the operations. Now we have to adjust for the income taxes paid. So what is the income taxes that is paid? So income tax payable at the beginning is 1.2 lakhs. 1.2 lakhs is the beginning, and for the current year, as per the P&L, we have made a provision for taxation of 8.8 lakhs. So for this year, P&L, we have made a provision of 8.8 lakhs. So I am adding that provision to the opening tax payable at the beginning. So total comes to 10 lakhs. And what is the closing tax payable? It is 1.3 lakhs is yet to be paid. So 1.32 lakhs I am reducing from 10 lakhs and finding 8.68 lakhs is the income taxes that is paid during the year. So 8.6 lakhs of income tax is adjusted to this, and you can find 30 lakhs is the net cash from operating activity. So net cash generated from operating activity is 30 lakhs. Next we will go for investing activity. Now what is the first? We have to see the balance sheet, and balance sheet, fixed assets, all the assets are like investments. 4.8 lakhs is the opening land value, and closing land value is 9.6 lakhs, which means you have bought land, because in asset side all the land will be recorded at the cost only. So you have bought land for 4.8 lakhs. So bought land, which means it's a cash outflow. So that's why purchase of land is in the within the bracket you can put, because it is a negative. Instead of putting a minus, you can put bracket for the cash outflow from investing activity. Next, purchase of building and equipment. Here opening is 36 lakh and closing is 57.6 lakhs. Here we cannot directly apply, because in the question there is a qualification, or there is a remarks that is given original cost of equipment. So some equipment has been sold during the year 7.2 lakhs. So here we have to calculate what is the purchase that has happened in building and equipment, because some sales has happened. Let's calculate that. So opening value of is 36 lakhs for building and equipment, and the equipment, some cost of the equipment that is sold. Okay, the cost of equipment that is sold during the year is 7.2 lakhs. So which means that is the book value of the asset that is sold during the year is 7.2 lakhs. So reduce that asset that is sold 7.2 lakhs. Now you get 28.8 lakhs as the real balance, real opening balance, and balance at the end is 57.6 lakhs. So 57.6 lakhs, the value of asset, land and the building and equipment has gone up. Okay, and adjusting for the 7.2 lakhs, and if we see the difference, 28.8 lakhs will be the purchase of building and equipments that is happened during the year. Now this purchases also I have brought inside the cash flow statement under the inflow activity, the investing activity. Next we have done the sales of equipment as given in the question. So what is the sales? How much we have sold? So cost price, original cost of the equipment sold is 7.2 lakhs. Now this original cost minus the depreciation of that equipment, how much depreciation has been charged, that should be calculated. For that we need to go for the depreciation figures that is given in the, yes, it is given in the balance sheet. Opening depreciation was 12 lakh, and for the current year we have made some depreciation, and closing depreciation is 13.2 lakhs. And for the current year also in the P&L you can see how much depreciation has been charged. Yes, you can see here 6 lakhs of depreciation has been charged in the current year. So 12 lakh is the opening depreciation, 6 lakhs is the current year depreciation, which means 18 lakh should be the closing depreciation in the balance sheet. But closing depreciation is only 13.2 lakhs. So where has the difference gone? So difference is the depreciation of the equipment that is sold. So 13.2 lakhs I am reducing, 4.8 lakhs is the depreciation of the equipment sold. So cost of the equipment is 7.2 lakhs. Depreciation on the equipment is 4.8 lakhs. So 2.4 lakhs is the 2.4 lakhs is the equipment that is sold. The value of equipment that is sold is 2.4 lakhs. Here one more important thing that we have to see in the P&L is there is a non-recurring income saying a profit on sale of equipment is 1.2 lakh. So the cost of equipment we have found 2.4 lakhs. Company has put profit, maybe 50% profit, 1.2 lakhs, and made a sales price of 3.6 lakhs. They have sold that equipment to the outside world. So you have to be very careful how we have done the adjustment to find what is the purchases of building and equipment. We have found the purchases of building and equipment. What is the accumulated depreciation adjustment, and found what is the depreciation with respect to the equipment that is sold. And now we have found the cost of the equipment that is sold, that is 2.4 lakh, and adding the profit as disclosed in the P&L to find the sales price of the equipment. And now we have found the sale of the equipment, sale value of the equipment, which is cost plus profit as per reported in the P&L, is 3.6 lakhs, and net cash is negative, which means net cash used in the investing activity is 30 lakhs. Now we will go to the last and most important part, which is the financing activity. And you can see in the balance sheet, share capital has gone up here from 36 lakhs to 44.4 lakhs, which is 8.4 lakhs. You have issued more shares and got some share capital. And dividends you have paid, here you can see dividends declared. If it is only dividends declared, the payment of dividend will happen in the next year only. It is not a cash outflow, but it is given here dividends declared and paid during the year, 7.2 lakhs. So 7.2 lakhs is reduced, and cash flow from financing activity is 1.2 lakh. Already we saw cash flow from operating activity 30 lakh inflow. Cash flow from investing activity is 30 lakh outflow, which is set off each other. Cash flow from financing activity is 1.2 lakh inflow. Now till this, now we will check the answer. And cash equivalents as per balance sheet opening is 6 lakhs and closing is 7.2 lakhs. So 6 lakh was the opening cash. Now closing cash is 7.2 lakhs, which means 1.2 lakhs cash you have generated. And as per cash flow statement also, it is 1.2 lakhs. It is tallying with each other, and hence your cash flow statement is perfectly right. Meet you very shortly with the next video on indirect method. Thank you guys. All the very best.